Yeah, what we do to measure silver gold, unlike what most people do, we divide 1 ounce of silver to 1 ounce of gold, express it as a percent. So
Hmm.
right now, silver's traded at about 1.15% the price of gold.
Uh-huh.
You go back 50 years, and we showed a graph of what was the highest reading each year of that silver divided into gold, highest monthly close, okay?
Hmm.
And 21 of those 50 years, it was at least 2%.
Hmm.
Okay, that was almost a norm. In fact, it didn't in the bull market years, 78, 9, and 80, 2010 and 11, for example.
Yeah.
Silver was up 3.5 to 6% price of
Hmm.
gold. Okay, but right now we're coming up off of a low that was just below 1%. And technically, when you examine the spread, which is effectively, it's a price chart, it's the price
Hmm.
of silver, price of gold. And we
Sure.
also run momentum of that spread. We're starting to get breakouts. And over the last like 5 months, for example, if you look at what silver's done versus gold, it's beat gold solidly.
Hmm. Hmm.
Okay. And I think that's the onset of a major shift where at minimum, silver is going to gush up to the 2% level again, which is,
Hmm.
again, that's not even extraordinary. It's routine. Why aren't we there now? Now, also another comment I'd like to make is, where's gold versus 2011 high? Well, it was 1920, it's 3,700. Okay, no issue about the 2000. Where's copper, a base metal?
Yeah.
It's trading above its 2011 high.
Uh-huh.
Okay, so is it outlandish to say that, hey, maybe markets have made a mistake? We
Hmm.
know that historically. Markets get overdone.
Yeah.
Markets get overdone on the downside, and they sit there and people say, oh, it's garbage. It's no good. And it's a mistake by a lot of investors. And finally, when reality hits, it wakes up in a way that jars everybody.
Hmm.
Well, silver is one of those situations, and its spread is arguing it's ready to ramp again. Its price action has begun to indicate that relative to gold, and it's up more in a year than gold is. Even just go back a full year, it's up more. And I think it's going to rampage over its old dual $50 highs, which are ridiculous old notions anyway. They're antique price highs,
Yeah.
and we're only up there for hours, by the way,
Yeah.
not weeks or months. And I think this next surge is going to carry us. This is not the top, by the way, into the 60s and 70s, the next surge. And I think it's possible it could happen this year.
Wow. Wow.
So, and now that's not the end of it. Ultimately, it wouldn't shock me that gold goes to its normal high. And by the way, I hear this on CNBC, et cetera, like gold it's gone vertical and you should sell vertical and buy, gold is not even halfway up in dimension, percent gain.
Uh-huh.
And what we saw from 1976 to 1980, an eightfold move, or from the 2000, 2001 lows to the 2011 high, an eightfold move. Gold would have to be about $8,500 to just match the dimension, the
Hmm.
ratio move of those two prior bull markets,
Hmm.
which occurred under circumstances that are far less earth-shaking, globally dramatic than what we're facing right now.
Right.
So
Well,
gold going to 8,000 would just be, I will say, oh, so what? December 2015, gold was
15.
$1,045. Okay,
Right.
that
Right.
was its bare low. Okay,
Right.
so you've tripled and a half. Okay, not eightfold. Okay, you ask about when does it end and where is it? I have a different view on that.
Hmm.
I think that what we're facing in global financial markets, in global institutions, particularly financially related, like central banks, and the nature of money
Hmm.
that's put out by government could change. I think so many things are going to change in the next year or so that you're not going to top gold, that it's going to level off and be institutionalized again as money.
Hmm.
This government, that government. Finally, the US probably be the last one to do it, where suddenly it's a gold-backed currency.
Hmm.
Uh, and it doesn't collapse again because we're back to a gold standard. We got off that with Roosevelt, and then Nixon helped. It's only been, 100 years that we've had the Fed, and about that we had Roosevelt, take everybody's gold from them. So it's not like it's forever that you have fiat currencies.
Hmm.
It's been an experiment of one long human lifetime.
Hmm.
And if it doesn't work well, and I think reality is going to demonstrate that, not just here, but elsewhere in the world,
Hmm.
then the public is going to get upset. There's going to be emotion. trends will be destabilized. And I don't mean Trump as a destabilizer. I mean, even he might be destabilized by the new forces, where we go toward, real money again.
Yes.
And all gold is expressing over the eons, decades, is the ongoing decay in the real value of money.
Yep.
Your granddad built a house, cost $4,400.
Mm-hmm.
Today it's $450,000.
Mm-hmm.
Okay, it's because of the decay in the money unit. I don't mean dollar versus yen or euro. I'm talking dollar's real buying power.
Mm-hmm.
Gold simply expresses that. It inhales and it exhales, but it keeps up with that ongoing decay. And I think we're going to be institutionalized. Wouldn't surprise me. Silver as well. Well, if we did a spread also of GDX versus, or SIL, the silver miners ETF, versus GDX. GDX does contain about 10 silver miners, by the way, so it does have some in there.
Mm-hmm.
But SIL is breaking out on a spread basis versus GDX. And we're just looking at the spread chart. It's really pretty much matched GDX for the last couple of years. It's held par status. In other words, it dropped from its 2020 highs versus GDX more than GDX did, therefore it underperformed. But over the last couple of years, it's really sort of gone sideways versus GDX in terms of relative gain, et cetera. But it's broken out now. And it looks like it's the same assumption we're operating on with silver versus gold. I think silver is going to outpace gold rapidly. I think silver miners are now going to be the better place to be among the miners than the gold miners. Not that the gold miners will do bad, but I think the silver miners will now catch up because they're as underpriced as silver is. For instance, GDX is out above its 2011 high. XAU index out above its 2011 high. SIL is in the 60s. Its 2011 high was 90. It's to go 50%. It's in the mid 60s right now. It could go up, nearly 50% just to get to it. So I think there's a lot of catch up that's going to occur. And my personal investments are more emphasized in the silver miners, and I even do options.
When most people think about silver and gold, they immediately go to the headline ratio. How many ounces of silver does it take to buy an ounce of gold? They'll say 85 to 1 or 80 to 1 or whatever the quote is that day. But I don't look at it that way. What we do is measure silver against gold in percentage terms. 1 ounce of silver divided by 1 ounce of gold expressed as a percent. Right now, silver is trading at about 1.15% of the price of gold. That's where we stand. Now let's step back 50 years. I've got the data, I've charted it, I've run the momentum. If you look at the highest reading each year, meaning the highest monthly close of that silver to gold percentage spread, 21 of those 50 years came in at 2% or higher. In other words, for almost half of the last 5 decades, it was routine for silver to be at least 2% of the price of gold. And in the great bull years, 1978, 79, and 1980, and again in 2010 and 2011, that spread surged to between 3.5% and 6%. So when I tell you that silver today, at just over 1%, is undervalued, I'm not talking about wishful thinking. I'm talking about long-term precedent. Historically, the 2% zone is not extraordinary, it's normal. The fact that we're not even there yet tells me markets are asleep at the wheel. And markets do this all the time. They underprice an asset, they leave it for dead, they dismiss it as garbage, and then reality hits. Suddenly the crowd wakes up, and the repricing is violent. Technically, when you examine this silver-gold spread as a chart in its own right, you can see the breakout forming. For the last 5 months, silver has been beating gold solidly. If you measure performance on a 1-year basis, silver is up more than gold. That's a shift. That's momentum quietly changing direction under the surface. I think it's the onset of a major turn, one that, at minimum, will carry silver back to that 2% level, which again is not a dream target. It's routine history. Now, some will say, okay, but why hasn't it happened yet? Gold is at record highs. Copper is above its 2011 high. Why hasn't silver joined the party? And my answer is, sometimes markets make mistakes. They overshoot on the downside, they linger too long in the trough, they bore you into submission, and then, when the base is complete, they lurch higher in a way that jars everybody. Silver is one of those situations right now. Consider the context. Gold's 2011 high was $1,920. Today, it's around $3,700. No question, it has more than doubled since then. Copper, a base metal, is also trading above its 2011 highs. But silver, for some reason, is still below its dual peaks around $50. And remember, we only touched those highs for a few hours in 1980 and 2011. They weren't multi-month levels, they were spikes. The idea that $50 is some kind of unbreakable ceiling is ridiculous. They're antique price highs, moments in history, not permanent barriers. When silver finally wakes up, it's going to rampage through those old highs. And the next surge is not going to stop at 50. I think it carries into the 60s and 70s, and it wouldn't shock me if that happens sooner than people expect, possibly even within the year. That's not the top. That's just the next stage. Now zoom out to gold. The media loves to say, gold's gone vertical, time to sell. CNBC brings on guests to say the move is overdone. Let me put this in perspective. In prior bull markets, gold went up eightfold. From the mid-1970s low to the 1980s high, eightfold. From the 2001 low to the 2011 high, eightfold. That's the pattern. Now take the December 2015 bear market low, $1,045. If gold were to match that historic eightfold move, you'd be looking at $8,500 an ounce. That's not pie in the sky, that's precedent. That's what gold has already done twice before, under circumstances less earth-shaking than what we're facing today. So gold at $3,700 is not vertical. It's not even halfway to where precedent suggests it can go. And the global backdrop today, monetary stress, debt overload, central bank distrust, geopolitical upheaval, is far more dramatic than the 1970s or 2000s. In that sense, $8,000 gold would not be shocking. It would be routine.
Long-term analysis of T-bond futures, we look at 30-year bond futures, been around for decades, okay? We turned major negative in October 2020, okay? And bonds then were 170 in price, a little over there actually. They dropped by 2022 down to near 100, okay? So they had a big collapse, meaning a huge rise in yields.
Right.
But since then, you could draw a line. If you get a yield chart, which would be upside, or price chart downside, you can draw a line from October of 2020 and draw a line across the chart. We haven't moved much. In other words, if it's a base in price, it's had its opportunities, and it's had numerous 2 or 3 rallies, efforts to get up out of the muck, okay? And it gets up into the 120s on T-bond futures, and they puke it right back down toward to 110 again. It just can't seem to get itself going. There's been 2 major efforts. This, I think, is the 3rd effort to get up out of here. I don't really think it's going to get really up out of here, so to speak, in a way that sustains. But I think you could get what we call a major counter-trend rally, meaning while the long-term metrics look negative, technical metrics, you could get a counter-trend rally against that is like maybe last 3, 4, 5 months, that kind of thing. And it would turn heads. People, oh boy, I got to buy bonds. Bonds have not been the alternative to the stock market that they have been in prior bear moves in the stock market. So, for example, in the drop we had from January to April in the S&P, if you look what happened at the end of April for the bonds, they puked. They dropped in 2 days from like 121 down to 111, like boom.
Oh, yeah.
Like that's a crash. So T-bonds weren't behaving opposite to the stock market. So large portfolio managers who might be skeptical of and want to move, 2, 3, 4, 5% out of the stock market into something they used to perceive as safer have been reluctant. It's not worked. But I think it might work now. And we've already crossed through some numbers this month that, that are fairly far below where you are right now that suggest, no, we've sort of broken out and we're going to get some kind of rally. From an investment point of view, I think the rally is a non-event. Yeah. From a trading point of view, you want to trade? Fine. There's probably a trade here. Buy T-bond futures, buy TLT, scoop out some money over the next several months as it goes up, and probably this stock market goes down. So finally, maybe the bonds act inverse to the stock market. Finally, But the ongoing alternative is always, monetary metals.
What is your outlook on the equity market now?
We still think technically that we're in a broad trouble. not troublesome, languishing top and pattern. We think that late last year, early this year, S&P was, we're about 9% or 8% above it right now. Okay. I think that was part of the topping process. I think this is also momentum says no, do not trust price new high. Quite often tops in the stock market. When you look at 2000, we turned bearish in January. That's the dot-com market of 2000. Well, heck, by August, they made a new high monthly close in the S&P. Okay. And it was enough to, for people to feel, oh, so comfortable, and it's going up forever because, it's been in a holding pattern. Now it's just pushed to a new high close. It was all a trap. It didn't work.
Now let's move into the implications. You've heard me say it before. Silver is coiled, gold is not done, miners are breaking out, fiat is failing. But what does that mean for how you actually navigate the markets? Let's get into it. First, silver's personality is different from gold's. Gold is the steady anchor, the slow but relentless mover. Silver is the volatile younger brother. It lags, it frustrates, it bores, and then it leaps. It drinks twice as much at the party and dances on the table while gold quietly sips in the corner. That's why silver's percentage moves are always bigger. And that's why silver miners can deliver outlandish gains when silver finally rips. We've already established that silver at 1.15% of gold is historically cheap. We've established that 2% is routine and 3 to 6% is bull market precedent. So when I say silver is going to rampage, I'm not being dramatic. I'm just looking at the tape of history. If gold is at $3,700 and silver moves to even 2% of that, you're talking about $74 silver. That's double where it is now. And if we get to 3%, you're over $110. That's not pie in the sky. That's mathematics. That's the same math that played out in 1980 and 2011. Now, will it be a straight line? Of course not. Silver never is. It will surge, correct, surge again. It will shake out weak hands. It will terrify you on red days. It will bore you on sideways weeks, and then it will reward the disciplined. That's its nature. If you can't handle that, stick with gold. But if you want the high beta payoff, silver is the place. Second, the miners. Let's revisit SIL versus GDX. Silver miners are breaking out relative to gold miners. That's the technical message. On a price basis, SIL still has nearly 50% upside just to get back to its old highs. Gold miners are already above theirs. That's the catch-up trade. And because miners always leverage the underlying metal, silver miners will leverage silver's breakout. That's why I've tilted my own positions more towards silver miners. They're underpriced, underowned, and technically set up for outperformance. Now let's tie this to the broader macro picture. Fiat money is failing. Look at your grandfather's house. He built it for $4,400. Today it's $450,000. That's not because houses got that much better. That's because the money got that much worse. Gold simply expresses the decay in money's real value. It inhales, it exhales, but over time it keeps up with the erosion. That's why gold is not a speculation. It's the measuring stick. And right now, the measuring stick is screaming that money is broken. Central banks know it. That's why they've been net buyers of gold for the last decade, led by China, Russia, Turkey, and others. They're hedging against the dollar system. They're preparing for a world where fiat trust is gone. And if central banks are doing it, why shouldn't you? Now here's the part the mainstream still doesn't get. This cycle might end differently. In 1980, gold spiked and collapsed because fiat still had credibility. In 2011, gold spiked and collapsed because the dollar still held sway. But today, after freezing Russian reserves, after weaponizing SWIFT, after $35 trillion in US debt, the credibility is gone. When gold spikes this time, governments may have no choice but to institutionalize it again. That could mean a new gold-backed currency, partial or full. It could mean digital currencies tied to gold. It could mean central banks openly marking their reserves to higher gold prices. However it plays out, the message is the same. Gold will not collapse back into irrelevance. It will be money again. And if gold is remonetized, silver comes along for the ride. Historically, silver has always been part of the monetary system. Bimetallism was a thing for centuries. It was only in the modern era that silver was demoted to just an industrial metal. That demotion was artificial. The market has never forgotten silver's dual role. And when the monetary reset comes, silver will be revalued not just as a commodity, but as money. So how do you position for this? First, own physical. Coins, bars, stored securely. ETFs are fine for trading, but when the system itself is in question, you want direct title. Second, own quality miners, especially silver miners, with strong balance sheets and real production. Avoid the junk explorers who dilute shareholders. Third, be patient. Silver will test you. It always does. But if you understand the structure, you won't be shaken out. Let's add some humor in a tweet here. Someone online said recently, silver is the most patient testing asset on Earth. It spends 90% of the time making you regret it and 10% of the time making you rich. That's true. The trick is surviving the 90% to enjoy the 10%. And the setup today says that 10% window is about to open. Now let's revisit gold's potential. From the December 2015 low at $1,045 to today's $3,700, gold has tripled and a half. That's a good move, but it's nowhere near the eightfold precedent of prior bull markets. To match that precedent, gold would need to be $8,500. And under today's conditions, global debt overload, fiat distrust, geopolitical chaos, that's not just possible, it's probable. And if gold goes to $8,500, silver at 2 to 3% of gold means $170 to $255 per ounce. Let that sink in. Now, I'm not saying that happens tomorrow. I'm saying the structure, the precedent, and the macro backdrop make it plausible. And if you wait until CNBC tells you silver is hot, you'll have missed most of the move. So here's the roadmap. Gold continues higher, potentially doubling again. Silver breaks out, first to 2% of gold, $74, then possibly 3% or more, $110 plus. Silver miners outperform gold miners as they catch up. Fiat continues to erode, pushing governments toward gold-backed solutions. And through it all, volatility tests your resolve. The key is to recognize the difference between noise and structure. Daily red candles are noise. Momentum breakouts are structure. Antique highs at $50 are noise. Historic ratio norms at 2 to 3% are structure. Media chatter about vertical gold is noise. Eightfold precedent is structure. If you keep that perspective, you won't get shaken out. You'll hold through the noise and you'll be positioned for the structural move. That's how you turn patience into profit. I'll close with one more anecdote. In 2011, silver spiked to $49 and change. People called it a bubble, but it only held there for a few hours. That's not a bubble. A bubble sustains. That was a spike, an antique high, an artifact. The real move is still ahead. And when it comes, it won't be a spike. It will be a repricing that sticks, because it will coincide with a monetary reset. So get ready. Silver is coiled. Gold is only halfway done. Miners are breaking out. Fiat is failing. The public is asleep. The opportunity is massive. And when the gusher comes, you'll want to be in position, not scrambling after the fact.
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.